Hey everybody, John Duncan here, and I just wanted to answer the question that is coming up, especially in today's crazy environment, and that is the stock market, like putting investing in the stock market worth, to go after the big returns? Is it worth the risk that's inherent in the market today? And to answer that, I wanted to first cover something that came out this morning, and that's Goldman Sachs says that stocks will drop 18% in the next 3 months. And they laid out six risks that they say investors are ignoring. Now, Goldman Sachs, as you know, I mean, they have a lot of smart people and they put a lot of money into research. So when they say something, it carries some weight. So let's look at what they say. The first big kind of risk factor is that the infection rate is outside of New York is actually increasing. Now, that could be due to more testing. It could be due to a lot of different factors. But if you look at it, and a lot of what's going on right now in the markets is based on an unknown, and the unknown is causing a lot of uncertainty. Uh, and if you look at the charts, essentially there's a growing infection rate outside of New York. And this comes on the heel of us reopening in a lot of states. Number two, they mention a lengthy reboot. And if you look at uh, places, other countries even that have started reopening before us, they are having real problems getting the economy going back up to full speed again. And I look at it like this: the longer that this goes on, the longer and harder it is to reboot. Um, it just is, because it's hard to, it's that old, I forgot the, body in motion tends to stay in motion. That whole thinking of body at rest tends to stay at rest. The longer we're at rest, the longer it could take to get things going again. Number three, a lot of US banks, all of major banks, are putting tons of money into reserves to protect against potential, a lot of loan defaults. They know as well as everybody else that the longer this goes on, you're going to have a lot of loans that can't be paid. And so they're putting a lot of money in hedging, against that uncertainty. Reason that's super important to you and me is it's the same thinking I'm talking about here. Yes, there are some great, great buys on the market, but compared to what? Compared to what they were. If this lingers on, it is going to be a huge. I think of it this way: the 18% that Goldman Sachs is saying, that's a guess. Everything at this point's a guess, because nobody knows how things are going to restart. Are we going to go and have another outbreak, massive, what? Nobody knows. It's a guess, is what I'm saying. Nobody has a crystal ball, including Goldman Sachs. Number four, slash dividends. Obviously, as things have turned down, the economy is basically shut down. Uh, More than 40 stocks have lowered already or declared they will not pay dividends at all. So, bottom line is that's an issue. Number five, I'm going through the six that Goldman Sachs says are issues that need to be accounted for that a lot of investors are ignoring. Number five is huge: the 2020 election. Regardless of which side of the aisle that you prefer, it's going to be a war going into this election, and that's going to have massive effects on the marketplace. Even if the coronavirus is behind us, we still have that to contend with this year. And depending on which side looks like it's going to win and ultimately does win, it's going to have massive effect on the market pricing. Again, that is, as an investor, you got to think about it. Should I be hedging a little bit? Should I be moving to cash with money? Should I just abandon the market altogether because it's not worth the upside's not worth it? Um, so these are questions that we all have to answer. And finally, number six, international tensions. I mean, we've got China and the whole it started with the tariffs. Now it's going to all different things, and you've got other hot spots around the world as well. All of these things could have a significant impact on the market. So bottom line is, if you've got money in the market that you can't afford to lose, then this might not be the time to be in the market. And I'm not saying pull every nickel out. I'm not saying that. I'm saying pull some money out. What if it does, instead of 18%, drop 50% or 60% or more? And why? How could that happen? Well, two or three of these things all at once. You could have massive escalation of tension around the world, as well as have the election go crazy, that situation, and have another hotspot for coronavirus all happen all at the same time. You'd have the market just go right down. So the point I'm trying to make is the upside looks tremendous, and it will be tremendous if everything goes back to somewhat normal in the near future. If these other six areas, which Goldman Sachs has said are being overlooked, if any one or multiple of those go the wrong way, then the market's going to drop substantially. And I just saw another report by Deutsche Bank this morning that was saying the same thing. They have drastically lowered their expectations for the market going forward. But what's interesting is they all say, well, it's going to be terrible, but by the end of the year, we're going to be right back to maybe even positive. What I would say to you, and this is where it is. We didn't see this thing coming. And number two, we don't know where it's going. Like, we do not know what is around the corner, and anything at this point is a guess. So having said that, maybe, each situation is different. Bottom line is, if you have zero money concerns at all, the money that you have in the market could be lost and not even missed at all. Maybe you just go even harder. You go look for deeper discounts. If money still is the money that you have in the market is something that you're counting on to a degree, this is a good time to find some good holdings and move some off of the table, move to safer investment holdings or move to cash. And if all the money you have in the market is to get from point A to point B, take it all out, go to cash or go to something safer. So that is my 2 cents on it. The upside looks great, but it will be a mirage if what Goldman Sachs is talking about actually materializes, where any of the six or a combination of the six force the market drastically down. Having some, maybe even half in cash, is a good thing. Then you buy back in at a much lower cost. It's very hard to argue these days to be 100% invested in a stock market with many factors, this much uncertainty, this many factors all at once going on. So with that, that is my 2 cents. Again, this was from the Goldman Sachs article this morning, where they revealed the research said that there's key six issues going on, that they feel that the market's going to drop 18% from where it is now, but end up the year 2% higher. All of that is a guess, but they did bring up some great points when it comes to uh, what we need to be paying attention to. So, with that, John Duncan, I'll talk to you next time.